Thank you for sharing your Wednesday night with me for AfroEconomics Live on Wednesday nights at 8. Go to AfroEconomics.com, go to events, and take advantage of more free events provided to you by the members of AfroEconomics. Yes, indeed. Powered by JB Bryan Financial Group, a registered investment advisory firm, the home of AfroEconomics that I started in 1995. Thank God. Yes, indeed. So tonight, Mr. Bozeman, Barbara, Ms. Dickens, Mr. McGee, Mr. Tice, Harold, Ms. Sherman, indeed, Mr. Piercy, yes, indeed, Mr. Walton, definitely Ms. Chandler. Thank you all so much, and all of you. Just know that if I didn't say your name, it's not because I don't appreciate you. I see you and I thank you. And once I start rolling, you all are just coming in. You know, I can't. So just know how much I appreciate you there, and I appreciate your support. We're talking about diversification of your assets, your portfolios. And one of the first things that we do, one of the first things that we do in membership of AfroEconomics is take a look at what you're doing. And if you have any questions about your portfolio, you can call in, but if you call in specifically about your business, no, but just generic questions about diversification, call me right now at 1-833-AFRO. I would love to have your question. It gets me excited when I hear my phone ring, but you will be live. I'm get really excited. We had calls last week. That was the first time I did this, so I got to come back with it. But 1-833-275-2376. So diversification. Diversification from an AfroEconomics perspective goes all the way back to the beginning of time. We can think about that, in any situation, way before the time of when they started bringing in slave ships. But when they were bringing slave ships, they wouldn't put all of the slaves on one ship. And they wouldn't put all of the slaves on the same space or in the same space, because that was their attempt to diversify. That was their attempt, and you also, you'll see that was their attempt to reduce their risk of losing all of the Africans that they were bringing in on the ship. Sad to say, but diversification, has been used in business repeatedly to reduce their risk. And I just use that because it makes me think about it. And there were things, when I've seen articles on the insurance companies that still exist today that were used to insure the ships and the product that they had was our ancestors. And they would have several different ships, and they would all be insured, and they would be trying to protect their risk. So if a disease or something came on one ship and everybody was killed, then they would have another ship so that they could make money off the other ship and cover their losses. So diversification is a risk management technique that mixes a wide variety of investments in a portfolio. So the rationale behind it is that a portfolio we should construct with different types of investments, and that each of the investments that we have in the portfolio should not always act exactly together, but they should, if they all acted together, then we're not really diversifying. But if you have investments in there who, when one is up and the other one tends not to do as well, or you have a particular stock investment in a company that is a consumer products company, and then you have that the basics, they make toilet paper and things that you're going to always need, so this basic product, this consumer products company might be not work in relation to technology stocks. They might work totally opposite, where the consumer products may do well even when the technologies are going lower. So that you're putting them in there to try to protect yourself. But if you have all of your stocks in technology, or all of them are in consumer products, then you feel like you diversified because you have 100 different consumer product stocks, but you haven't diversified because they're all the same thing. So you can diversify within an asset class, or you can diversify across asset classes, and that is called asset allocation. And we've done a discussion on asset allocation as well. It's kind of an advanced movement of diversifying. So we think that just because you have a lot of something that you've diversified, but when you do asset classes, if we use the horrible parallel of the slave ship scenario, then what they did when they would put different ships and divide up the slaves, they were that was their attempt to go into different asset classes. So if this ship doesn't make it, then this other ship may make it. So that's what we're doing with some stocks, some bonds, some real estate, some commodities, some cash, of course. But your diversification and diversified in how much you have of each of the asset classes it has a huge effect on your return, because a portfolio that's made up historically. Now, all of this is, I'll have to add that disclaimer, that historical performance is no guarantee of future results. But historically, a portfolio that's dominated by good, strong equity positions will outperform a portfolio that doesn't have that exposure to stocks, equities. So that may have 90% bonds and 10% stocks versus 90% stocks and 10% bonds. But of course, you're talking about hugely different time horizon, risk tolerance levels, and everything. Those are the things that impact my decision on how your asset allocation is going to be and how you divide across asset classes, because each asset class is carrying a different risk tolerance level with it. So if we do some stocks, and we're doing stocks, but some of the stocks that you wanted to have commodity exposure, then we could use, there are actually, and we talked about this in the economic update on Monday, and I think, I want to just go back to that now a small investor can get involved in the commodities market through using ETFs. And so we'll even have a discussion, but that's where you come to, that's where it gets intense, and you have to talk to me, and I do your risk analysis, and we talk about what your interests are, and we get deep into that. So, but the bottom line, that diversification is a risk management technique that mixes a wide variety of investments within a portfolio. That is. That's the textbook, but I think that I hope that I've translated that well. But that's why I have the handy dandy telephone number for you to call, 1-833-275-2376. Hey, Dr. Hicks, if you all don't call me, then I know you're doing wrong, because this topic is made for questions, and it's made for you to follow up with it, and it's made for you to make sure that during your meeting with me, if you're a member, anybody that's listening, my office will always offer a complimentary consultation to you, that we can talk about things. Definitely. Yes, indeed, Ms. Sherman. You are so good to me. I'm going to give you a member award, girlfriend. You are so far from me. She's in Ohio. Yes, indeed. But she said, are you recording? I don't see the button on. I have the button on. You're so good. Do you see it now? I love you. You're the best. So so let's talk about how you could possibly be over diversified. And I run into this all the time, all the time. The Jill Scott too, she wanted to come back. The screen went black, so I clicked it and her song started playing again. I love it. So I think of this one. So my question for tonight is, are you over diversified? And you would be amazed at how many times when I look at people's existing portfolio, that the key thing is over diversification. There is this huge movement where you're going to these work plans, and the work plans now have this computer and this advisor and attached to it. They say an advisor, but this computer has this predetermined portfolio, and then they charge you a fee, and typically it is over diversified. Over diversified, like, how do you know when you're over diversified? So I'll put down these notes. Like, if you want to be conscious of this, if you find yourself owning too many mutual funds within the same investment category, like they have their little computer and it'll say growth funds, and have the growth category, and then you'll have 5%, 5%, 10%, 5%, 15%, all in that growth category. Then it'll go to growth and income, 5%, 2%, 1%, 3%, all in 6 different funds. Like, so you have all of these like broken down in the same investment category, and then it'll just bonds, 2%, 3%, 4%, 5%, 6%, 7%, you know what I mean? All it is, so that it wants to take advantage of, I guess, of all of the investment options available or something. I'm not sure like why, but I guess because it's a machine, and or they have promised all of the investments that are in their portfolio that they would send them some of the assets or something. So, because you just never know what is behind the incentive of why they would over diversify you. But if they have all of those investment companies, I want to make sure that is quiet. But if they have all of those investment companies available and they're participating in it, they may have made some sort of commitment to make sure that some assets are going to each one. So if they set you up and you have all of these people that are automated, then they can make sure, they can tell them, stay with us because we're going to send you such and such amount of assets every year. And so that is interesting that I see that repeatedly for us, of just being over diversified and owning so many of the mutual funds in the same category. The second point, some ways of just some cue points. These are just some suggestions, some more things that I want you to think about. When I look at your portfolio, I immediately, these are the things that happen to me, and it's about trying to articulate things that I just do. Like, I don't go, because I've been doing this 20-something years. It's just like anything that you do at your job. These things like naturally come to me, like, oh my gosh. How many mutual funds do you need that contain Facebook? I mean, how many different ones? So anyway, so it's my job to make sure that we're selecting the top performers out of there in setting up a strategy of trying to reduce your fees and expenses as well. So you'll see a lot more disclosure that's happening. Like, as an investment advisor, everything has to be full disclosure. You'll see it on any of your statements that the assets are under management with me. Everything has to be full disclosure. Any fee that I've charged, anything, any expense that you incur, and hopefully you'll see it beginning to happen at your workplace and in your other investments too. So also, the second point is how to look out for over diversification is to be careful with having a whole bunch of multi-managed investment. So you have the mutual fund. So I don't do, as an independent advisor, I don't do mutual funds. anymore anyway. I focus because mutual funds have fees that you're paying people to do what I do. So many people, many of you out there listening, have mutual funds that you're on top of that paying an advisor to charge you a fee on top of that, because that's how the industry is moving, especially through the work plans, which is really sad. So we have to be aware of that. They're charging a fee already and internally. So you're paying higher fees because it's a mutual fund that has managers on it. So you have multi-management levels. You have the manager of the fund, and on top of that, you have a manager of your account. So you're paying multiple fees and multiple managers. And then sometimes you'll have someone that's an advisor like me who has funds that are wrapped in a management group on top of that. So we got 3 levels, 2 or 3 that they're coming through that are happening to you, but you feel important because it's with this big company and you think that, that you're coming out ahead. And unfortunately, you have to be very conscious, really be careful. Dr. X said, bingo. Thanks for your help on that. Thank you for allowing me to assist you. So and then we have another sign of over diversification is having a huge number of individual stocks in your portfolio. I can show you the research, that shows that when you get between 10 and 20, you're about as diversified as you need to be, as long as you pick some good winning stocks. When you start, if you got the same amount of money, let's, just say you have $100,000 and you have a winner in there, but you're taking that 100,000 and you decided that you want to divide it across 50 stocks versus 20 stocks. Well, that winner can't produce for you, as much because you have such a small position in your winner. So you have to make sure that you're more careful on your selection so that diversification can work for you and not against you. Because you go like, I want 1,000 of this, 1,000 of that, 1,000 of this, 1,000 of that, 1,000 of this, and one of those thousands actually doubles. So imagine if you had done 5,000 in that one, 5,000, 5,000, and divided it up like 10 different ways, instead of 50 different ways or 20 different ways. But, the closer you can get to 10, 12, 15, it just really, but when you get past 20, you're really in, according to research, you're overdoing it and you're reducing your chances. So you've killed your return in your attempt to reduce your risk. And we can talk more about that. Seek financial advice. That's the disclaimer. Don't take my word for it. Just come in and take my word for it privately. So and a final point on signs of being over diversified, and then I want to make sure, because I had some other things I wanted to I'll make sure, because I put down some notes. I have a lot I want to tell y'all this time. Definitely. So I got that and I got this. Great. So I'm going to tell you that. I'm glad I remembered that, because I'd be mad and I'd be like, oh, wow, I put those notes. I wanted to tell them today. So then a final is be careful. This is a final of the sub-final. The real final is when I go to this. So be careful. Watch your non-publicly traded investments that are basically like your publicly traded investments. So that is to say, things like real estate. You can have, there's a whole bunch of like real estate partnerships, real estate investment trusts that are not publicly traded. They're not available, so you can't sell them any day that you want to. So you have to realize that you could just be defeating yourself and exposing yourself to some unnecessary risk, because those alternative investments that you're utilizing, you actually could have gotten access to them through some not so alternative, but you actually could, do publicly traded real estate investment trusts. And, so, and then just investing directly into a technology company, just say. You see these people and they say they're starting this new company and they want you to invest in it and they want to compete with Intel or Microsoft or something like that, and you want to get in it because they're going to be the next Intel. Well, be very careful with that when you already own Intel or already own Microsoft stock. So you're over diversifying and exposing yourself to additional risk, and you've already got a base or exposure into that particular industry or sector in a publicly traded fashion. So that's kind of intense, but you are, and then also when you do non-publicly traded investments and you add them to your portfolio, then, say that we could do a real estate investment trust that's publicly traded. That means they have to tell us all of the investments that are held within it. So they said, I have all these real estate companies, and if they're publicly traded, it has to meet the regulatory requirements. But if you decide, I want to do this private one, I saw this guy online, and he has this real estate fund, and he wants me to invest in it, but he's giving you this list of properties, but it has not gone through the regulation. So you have this public one that you have all the regulations. We've looked at all the properties. We looked at what they invest in. And then you already have that exposure in your portfolio. We're getting it. We have the real estate in there. And then you go out and do this non-public one, meaning you can't just sell out of it whenever you want to. You just can't say, sell those shares, sell all of that, give me my money out of that. I don't want that anymore. No, you have to go through these people. You have to wait until they tell you can sell it. It might not, so your liquidity is reduced, and you're increasing your exposure and your risk exposure unnecessarily. And it's not, so you're not even just, do you think that you're diversifying because you want to do some more real estate and you want to do it this way? That's just using that as an example. And you're like, I want to do some alternative investments. I want to do it this way, when really you haven't done anything to help your portfolio overall, and you may have increased your risk exposure. So just be very careful with your investments, because diversification can turn into diversification. You can be making things worse. Ask me any questions at 1-833-275-2376. I'm going to be disappointed if somebody does not bring that phone. I probably won't talk to you all again until members only on Friday. Look, I'll be disappointed. Somebody bring that phone and ask a question. So let's do the diversify within asset classes. Diversifying and closing out my notes I had. That diversifying, I want you to note that you can diversify within asset classes, diversify within sectors. So when you diversify within asset classes, remember that's having a lot of different stocks, but not over diversifying, having several bond funds, but not too much, or having certain different bonds or having different individual stocks, because you could actually have a good fund. You can have too many. Remember, you can diversify with the mutual funds. You can over diversify with ETFs as well. So how many different times do you have to have the same thing? So everything needs to be contributing something different to your portfolio. Diversify within sectors. So, and then diversify asset allocation. We talked about different asset classes, having the real estate, having the stocks, having the bonds, having the cash, having the commodities, as depending on your risk level and your goals. And having a cash reserve is a big part of diversification as well, because you got to have that cash reserve in order to make sure that you can purchase things. The oh, I didn't look. It didn't come up on the right. Did it come up in here? Well, I'm gonna use this, y'all. Thank you for calling in. We have a call from Virginia. 1 second. The it's all Delia's fault. I don't know. She's like, look, it's all Delia's fault. I'm just joking. It's not your fault at all. The I think, oh, we just lost you. That's all. Please call back. That was good. The call from Virginia was like, no, she just said she wanted to call. She didn't say I had to talk. Uh-oh, wait. Let's try it. Thank you for calling. Thank you for calling. Hello.
Hey, baby.
How's it going? Thank you for calling.
Thank you. Thank you for having me. I'm on the road traveling.
I don't, can you all hear? Can you all hear? I don't know if they can hear. I know, it's kind of breaking up, but ask me your question.
Okay, my thing is, you kind of touched on get away from mutual funds. Is it best to, as we get towards our 50s, for us to stay away from the stock market or just to be comfortable?
Okay, thank you. I'm gonna answer it on the air. That's your question. Let me repeat. Let me make sure. Was your question when you grow up and you're in your 50 plus, is it best to stay away from the stock market?
That's correct, ma'am.
Okay, here we go. All right, thank you. Bye-bye. So it was a very good question. They were asking about, like, should you stay away from the stock market, as you get older? Now, remember, when I say stocks and I'm talking about equities, I'm saying equities in any fashion. So equities, stocks in a mutual fund or in a ETF, exchange traded fund, that are stocks in your portfolio, and it can be in any form, not just individual stocks, because sometimes I was saying about, and during our quarterly analysis earlier this week, the interest that was in Nike stock after the ad ran, and most of the people that called that were members that are clients in some capacity already had it in their portfolio. So, but they really had not thought about what they had in their portfolio, which that is, it gave me a great opportunity to say, look what you have in this. So that Nike is in the Dow, Nike is in the S&P 500, that Nike is, held in a lot of indexes. So, yeah, but yes, stocks and stock funds are extremely necessary at every point of life. That definitely you need to have the stock exposure. How much of the stock exposure you have, depends on your risk tolerance. There's people who are not in their 50 plus who are conservative and are not comfortable. So it takes that's why financial planning is so important, because the more we talk about it, the more exposure, the more I teach them, the more I show them historical performance and what they're buying, and to get an understanding of what stocks really are, then they increase their confidence, because people invest in things that they understand. That's what you should be doing. If you don't understand it, your chances of really benefiting from the investment are reduced, because when people don't understand things, they sell them at the slightest drop. So we have to be very conscious, of how important it is for us to, how important it is for us to include equities at each point of our life, because they are historically good long-term investments to help you keep up with the rate of inflation. The cost of things are going up. So even if you're 80, you might not have a high percentage of your portfolio in equities, but you might actually have a high percentage. You might not be even depending on your portfolio for income. It might be that you're investing now for the next generation. So for the next generation, you may have a large equity exposure because you're doing it for your children's children. So it really depends on the goals of the money, how long you think before you're going to start to need it. And I think that at every point in our life, we need to think about living on interest and dividends, not on spending our money. So we need to accumulate so much money that we can live off the earnings from that money. So that means we having a whole lot of money or having having a little teeny bit of bills, right? So we want to do both. We want to focus on saving and we want to reduce our bills. The funny thing is, if you are constantly doing a well-diversified portfolio, investing in it consistently, you're going to automatically reduce your bills because you're not going to be accumulating a lot of debt. You shouldn't be. So we want to be very conscious of what you do today determines how you live 30 years from today. But yes, I believe that stocks can be a part of our life. Stocks in whatever format that we like. Does not have to be individual stocks, but when we're including equities in our portfolios. I have all of my investment portfolios, unless it's just they want money market. All of them include some equity position. Thank you. Yes, indeed. So please, before I go, if you have any question, I'm going to give you one more second to 1-833-275-2376. And thank you to the caller in Virginia for your call. Yes, indeed. And then do you have any other questions? It'd be great. Last week we had both of our callers from Maryland. I thought that was interesting. Yes, indeed. So then, and I had that as one of my notes. So make the assumption that it may go down to always having a cash reserve. I don't know why I wrote that, but I said that. Make the assumption that it may go down. The investment market. So let's live under the assumption that things may not always be great in the stock market like we're experiencing now. So in order to avoid not having to spend your investments, or being terrified, because one thing that we can always depend on is inconsistency. We've been having a really long ride up, but we need dips so that you can take advantage of buying opportunities. It's just the way of life. Things are always going to change. But over the long term, it's the person who wins in the stock market is the person who is going to allow it to benefit them over the long term. Because you're like, what we know as the peak now is not going to, may God allow it, is not going to be the peak 20 years from now. We'll be saying, them days, look how much better it's doing now. That's what we want to experience. So then live off the interest, dividends, protect the principal of your money when you start withdrawing and living off of it. But over diversification, in summary, can be a challenge. I see it in portfolios when I do analysis all the time. So that's one of the key things that we do need to work on and be aware of. Just because you have a whole lot of stuff and a lot of you at a lot of different places does not mean that your portfolio is giving you the best performance that it can provide. Yes, indeed. Mr. Bozeman says, so should I look at the 800-point drop in the market as an opportunity? I would love to hear your voice. I wish you would call one day. You are a good friend. You are, indeed. And I've never heard your voice. And thank you for supporting AfroEconomics. We love you as a member. What should I do with the knowledge of the Dow dropping over 800 points today? Yes, indeed, you should see it. You should definitely see it as, wow, this is just 800 points because the market has been doing so great all year. And then you should also see it as an opportunity to be glad that you have that cash reserve and then look for buying opportunities. If you have things that we've been following or for some reason you may have been waiting, I just feel that you can't wait to get into the market. You can do what's called dollar cost averaging, where you're consistently putting in money over a period of time. And then when the market does dip, when you're being consistently adding to the market, that's during the accumulation phase, that you're able to take advantage of lower prices, but you've already selected what investment you want it to be in. So we have to be ready for the investment. If you were looking for a particular investment to drop, because it could, be up 1,000 points by the time the market opens in the morning. But definitely know that indeed the equity market, and as is, the bond market, you're going to have some volatility there. The bond market has volatility in interest rates. Interest rates have been going up, and when interest rates go up, the value of your existing bonds that you're holding at lower interest rates, the value goes down. So Mr. McGee says, Ms. Bryan, can you repeat what you said about the person who wins the stock markets wins in the person who wins the stock market wins in, I don't know. But it is definitely recorded on YouTube. But I probably said something that sounds like that. But the person who wins in the stock market, I don't think I said that, David. But the person that participates in the stock market, I probably was saying about the person who participates in the stock market over the long term benefits, over the most, because they don't get caught up on the short term volatility. So if we base that statement on historical performance, the longer, if you give your investments 10 years or more to perform for you, given good investments, given that I'm your advisor, but, it definitely seek financial advice on that. But, historical performance has shown that the longer you give stock investments to grow for you, typically you're going to have more success, using the S&P 500 as an example of its historical performance over the long term. So equities are long term considered growth. Some of them are aggressive growth. And so the more growth oriented it is, you have to give it time to grow. What you think? I hope that answered that. I'm glad you're participating, Mr. McGee. Indeed, we're getting more and more members in their 20s, and I believe that is really, what God wants us to do, to cover all ages. Yes, indeed. But I'm here for you. I want to hear your specific questions. I want to talk to you about your specific portfolio, your goals. Please share this information. I'm going to be posting it on YouTube, and I'm going to be posting it on YouTube. So if you need it, go to the YouTube channel. And if you need it, don't hesitate to email me, jb@jbbryan.com, and I can send you the link to it as well. Have a wonderful, wonderful day. And this was about portfolio diversification. Are you over diversified? It is definitely something worth listening to twice. I don't like listening to it twice, but definitely listen to it again. And I hope that the tips just keep flowing. I'm here to help you. Have a wonderful day. A good night. Bye.